Hey everyone, welcome back to another dividend investing video. If this is your first time here, I like to talk about stocks from companies that grow their dividends year after year, allowing us as dividend growth investors to create a growing source of passive income. Today, I'm talking about a food company that hiked its dividend by 100% today. Yes, you heard that correct. In one day, this company doubled the size of its dividend payment. It's not every day I could talk about a company doubling its dividend, so I thought it warranted a video. Today we'll go over the company, look at the fundamentals. I'm going to try to determine a fair value and figure out if this is a worthwhile investment for dividend growth investors. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru, just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could do me a favor and smash that like button and subscribe to keep up with future videos, this helps us out more than you can imagine in bringing you quality dividend investing content. Folks, when I saw the headline, I thought it was a mistake, but on the morning of January 13th, 2023, Friday the 13th, the Wendy's company announced they were doubling their dividend from 12.5 cents to 25 cents per share with an ex-dividend date of February 28th. At the time of the announcement, that set the forward yield of Wendy's shares to a surprising 4.59% yield. In addition to the dividend hike, Wendy's also announced a $500 million share repurchase authorization. Wendy's posted preliminary Q4 results that exceeded expectations, and shares of Wendy's, which trade under the ticker WEN, shot up 6% that day on the news. Companies make massive raises to their dividends, and investors take note. I don't need to get too much into what Wendy's does. They are a massive fast food company that everyone knows. They're the third largest hamburger fast food chain behind Burger King, which trades as QSR, and McDonald's, which trades as MCD. And their products are decent. I love a good chocolate frosty with a junior bacon. And this 100% raise aside, is this company worth investing in for the long term for dividend growth investors? Try and take an objective look at this and ignore the fact that I enjoy their burgers. The first thing I want to show you is this chart from Simply Safe Dividends. It's the dividend growth chart, and note there have been 2 dividend cuts made by Wendy's in the last 15 years. It was cut during the recession of 2008, and then again during the pandemic of 2020. This is not a great track record. Now, their latest dividend raise is not plotted on this graph because the dividend is now $1 annually. But here's a chart from Seeking Alpha that has the dividend history with the latest increase, and it dates back to 2004. And this is interesting. With today's new increase, Wendy's long-term dividend investors from back in 2007 or 2008 are finally made whole from the dividend cut sustained back in the Great Recession. Ugh. Now compare this to their main competitor, McDonald's, right? This is one of the strongest dividend growth stocks in modern history, doing it for 45 years. Pandemics, recessions, inflations, whatever, McDonald's has kept that dividend growing every single year. And as a guy who wants to live on my dividends someday, I would much prefer to stick with companies that have a track record like this. That's not to say that Wendy's is a bad investment by now. The 100% raise is impressive, and it looks like their business could be recovering after a tough stretch. And it's also important to remember that past performance is not a guarantee in any way of what will happen in the future. And I do think a mid-cap company like Wendy's is going to carry more risk than your average restaurant such as a McDonald's or the Starbucks of the world. And they also offer more potential reward and growth. So it's all about your own risk tolerance. About the dividend, is it a safe dividend? According to Simply Safe Dividends, the dividend payout makes up 54% of forward earnings, but I'm unsure if this has been updated for their dividend hike. I don't think it has been. The dividend is paid out in the months of March, June, September, and December as a quarterly payment of 25 cents for a total annual payout of $1 per share. Simply Safe Dividends gives us a safety score of 50. That is borderline safe, and to compare right now, they give McDonald's a safety score of 77, which is considered safe. Starbucks has a rating of 67, which is also considered safe. This furthers my argument that Wendy's is just a riskier stock than your classic dividend growth stocks in the food space. In fact, doing some digging using Simply Safe Dividend Stock Screener, McDonald's and Starbucks are the only companies in the space that have safe scores and didn't cut their dividend in 2020. Now, there are 3 others with safe scores that did cut, and I have a video coming out on this topic in February, so make sure you're subscribed for that. But dividend cuts in 2020 in restaurants were very common. You have to keep this in mind if you're going to invest in these types of businesses. Okay, so next I'm going to compare Wendy's a bit more to the other main dividend growth companies in the restaurant space. Here in Seeking Alpha, there's this Peers tab that really lets you make nice comparisons. I put in Wendy's with McDonald's, Starbucks, and Domino's Pizza. The first thing you notice is just how massive McDonald's really is. Even though Wendy's is the third largest burger chain, its $4.6 billion market cap dwarfs McDonald's, which is flirting with a market cap of $200 billion. So here we have the performance of all four on a chart. Here's the price return, and we can see that Wendy's over the last year is only down about 2%. McDonald's and Starbucks are actually up a little bit over the last year by a few points. And Domino's had a rough year, down almost 30%. Could there be opportunity in that one? Well, that's a topic for a future video. Now, I'm going to switch this chart to total return so we can see the dividend in its return. And with the dividend being important in your overall returns, notice with the dividend paid, you didn't lose any money in Wendy's investment had you purchased 1 year ago today. Let's zoom out to the 5-year performance. And I know Wendy's is the lowest performer out of the four in terms of growth. It's cool to be able to compare companies like this. The 54% total return, I believe, is a little better than the S&P 500 over the same time span. So the big restaurants have been outperforming the market. With Starbucks, you nearly double your money over the last 5 years, even with the pandemic and 2002 bear market, which was the worst year for stocks since 2008. And let's go out even further. And guys, this is why investing is a long-term game. You would have done very well holding really any of these four stocks for a 10-year time frame. This is not a get-rich-quick game. It's a legit get-rich-slow game. The best part is, you know these companies. You're most likely customers of at least one of them on a regular basis. Wendy's returns are up over 500% over the last decade. Domino's is slaying it with over 700% returns. Scrolling down a little bit more, we can see Wendy's and all its competitors are trading at high valuations. They are profitable companies, but they are expensive. I was going to compare this dividend info, but it's not yet been updated with the new raise, and Wendy's is trading at above a 4% yield now. But it's nice to be able to compare this data side by side. So Wendy's is trading at a PE of 25.1. This is a good bit below its 5-year average of 29.6. So while it's an expensive stock, relatively cheaper than it's been over the last 5 years, and the other food companies really are the same way. If you want to buy them, you're going to pay a premium. It looks like Wendy's buys back shares at a pretty aggressive rate every year. Outstanding shares are down over the last 10 years from 392 million in 2012 to 217 million in 2022. Now that number will go down even more this year when they buy back another 500 million worth of Wendy's shares. So I did run Wendy's through various valuation modes and try to come up with a fair value, and I'll show you that next. But first, I've been asked for ways to support the work we are doing on the channel, so I've created a couple ways that you can do so. First, I made an account at buymeacoffee.com where you could buy me a coffee as a way to support the channel. Link is in the description, but personally, I'd rather you use your money to buy dividend stocks, but if you do want to support my work in this way, it is much appreciated. And second, much of the data I'm presenting here and much of my research come from the website Seeking Alpha, and I've partnered with them to bring you a wonderful offer of 50% off your first year of their premium membership. This comes out to about $12 per month, and I think this is a great value for all the information you get on Seeking Alpha as well as the excellent articles. This site is instrumental in my research to produce the content I do for you guys, so you can use the link in the description to get 50% off, and this is a great way to support the channel. Okay, so let's talk valuation models. I look at several usually because no one model is perfect on its own. So what I do is I take Graham's valuation, a dividend discount model, a discounted free cash flow model, then I add in a couple relative valuations based on historical dividend yield, historical PE, and the average analyst price target. What I do is I take the average of these to determine a fair value, and then I can apply a margin of safety to come up with a buy price. Alright, here's my spreadsheet that I use to combine these various valuation methods. I put in the ticker WEN and the dividend of $1 annually, a forward PE of 25.1, and a forward earnings per share of 87 cents. Let's first look at Graham's valuation. I added a projected growth rate of 9% after doing a little bit of digging, and the current rate of the 20-year AAA bond is 4.4%, so with that we have a fair value of $14.72. Looking at a dividend discount model valuation, this one was hard. I wanted to be conservative. We have to consider there have been 2 dividend cuts in the last 15 years. So I'm going to go with a 6% dividend growth rate and a 9% discount rate. This gives us a fair value of $35.33. Moving along to discounted cash flow, Wendy's has about $170 million in free cash flow, and I'm projecting a 7% growth rate and a 3% perpetual growth rate with a 9% discount rate, taking the combined value of future cash flow and dividing by the 217 million shares outstanding. This gives us a fair value of $15.90. So that's another pretty rough valuation. I usually like to do a relative valuation method based on the historical 5-year dividend yield, but I don't like it for this one because of the recent dividend cuts and the oversized raises. Reverting back to a 2% yield at this point seems quite unlikely, but if Wendy's were to trade at its average 2.05% yield, it would be valued at $48.78. I'm going to take this one out of the average. I don't think it's very useful. For a PE mean reversion, this one is more reasonable. Wendy's is trading at a 25.1 forward PE, and if this were to revert back to its historical norm of 29.6, this would have Wendy's trading today at $27.23. Finally, let's factor in the average analyst price target. Seeking Alpha gives us a nice graph, and the analysts see this as a $23.92 stock, and it's already a $23 stock. Averaging these fives together, I get an estimated fair value of $23.42, which means right now Wendy's is trading near its estimated fair value in my opinion. Of course, do your own due diligence. I could have something wrong here in a projection, or a calculation could be off on one of these valuations. Now, does this make Wendy's a buy? Well, I like to add a margin of safety, and that can vary depending on the company in question. I do like to take into account how risky its dividend is and the overall investment. As said, this isn't your McDonald's or Starbucks. It does carry some additional risk. With the McDonald's, I'd be happy with a 10 to 20% margin of safety, but for Wendy's, let's start with a 30% margin of safety. This gives us a target buy price of $16.39, and would have to fall about 29% to get to that level. If you want to be even more cautious, a 40% margin gives us a target buy price of $14.05. For me, really, this isn't something you likely see me investing in, as I am looking for safer investments for dividend safety. I'm 41, so I'm not old, but I don't have the time of, say, a 20 or 30-year-old. And around the $15 mark, it does look like a pretty compelling stock and may be worthy of a small position. Of course, the stock has the potential to do very well if you have the patience to hold on through some of the volatility. That's my thoughts on Wendy's. Again, not financial advice. One thing I enjoy about Wendy's is that 4 for $4 bag. That could be helpful for the dividend investor looking for cheap eats to help get more dollars into their portfolio. And so that's how I'll be using Wendy's going forward, most likely. Let me know in the comments if you happen to own this one. What do you think of it? Does the 100% raise have you interested? I'll definitely be watching it over the next few years. Guys, if you aren't following me on Twitter, you can do so at Div Growth Income. I enjoy connecting with you folks. And if you've stuck around this long, you are my people. I appreciate you, so please subscribe. And until next time, guys, keep investing.